Hi, I'm Regan Hagestad with Watermark Home Loans, and today I wanted to discuss a topic that I get asked all the time, and that is, why would I buy now versus buying later? There's only one place for interest rates to go, and that's up. The question is when, but the bigger question is, how will that affect you on a monthly basis, as well as on a down payment side? I know that rates going up is kind of a general and simple statement, but at the same time, I wanted to give a real-time example of how that can affect a homeowner. In August of 2012, I had a client who purchased his home for $800,000. He put $240,000 down, which gave him a loan of $560,000. Now at that time, interest rates were 3.5%, which yielded a monthly payment of $25.13 per month. Homes are now selling in his immediate neighborhood, similar square footage, bedroom, bathroom count, for between $880,000 and $950,000. So even if we take the conservative approach and assume he had waited and now purchased a home for $880,000, he'd really have one of two choices. The first option he'd have would be to put the exact same amount of money down, which was $240,000. However, in this case, because he's now purchasing a home that's higher priced, instead of borrowing $560,000 like he did, he'd now be borrowing $640,000. The other factor that comes into play is that interest rates are now 4.5%, which is 1% higher than they were in August of 2012. In this situation, my client's payment would be $3,242 compared to the $2,514 it was in August of 2012. That's $728 a month difference for the exact same home. The second option for my client would be to come up with $320,000 versus the $240,000 he put down in August of 2012. That would be a close apples to apples comparison because it would give him the exact same loan amount of $560,000. Now let's assume my clients decided to go with scenario number 2. They'd have to put an additional $80,000 down now in order to have the exact same loan amount. But in turn, because interest rates are higher, their payment would actually be $2,837, which is $323 more per month for the exact same house, compared to 16 months ago when they were able to buy their house for $800,000. As you can see, my client who purchased in August of 2012 and obtained the 3.5% interest rate, they're able in option number 1 to save $729 a month, which is $264,000 over the life of the loan. Or if my clients had chose to go with option number 2, but pay the higher price because the market has increased and interest rates have changed, they would actually lose $323 per month, which is $116,000 over the life of the loan, simply because they waited 16 months to purchase their property. Depending on each individual client's scenario, these dollar figures may change, but the theory and the math of this is going to remain the same.
When interest rates do go up, if they go up by half a point or a point, it really changes the purchasing power of that buyer. And most buyers today, when they begin their search for a property, they may start out at $800,000, but pretty soon the $850,000 home looks a lot better, and then the $900,000 home looks even better than the $850,000. If that mortgage changes from $3,000 to $3,500, it just took him out of that bracket, of that $900,000 purchase bracket. So when interest rates change, things change immediately for a buyer. For a seller, it may take a few months before they realize why that same buyer is not looking at my house anymore. But for a buyer, the change is immediate. So that's why I don't encourage anyone to wait to buy, because it's only going to get that much more expensive.